Hey, it's Art Stewart here from Strategic Impact Partners, and welcome to another edition of What Matters Most here on LinkedIn and YouTube. And Elliot Schreiber is with me today. Elliot, great to see you.
Great to see you, Art. Thanks for having me.
Well, I'm glad that we could spend some time together, kind of going over a lot of stuff that we both share some great passion over. And, you know, one of them is really kind of at the crux of what's going on right now. And I know you're in the heart of it physically and also in your work around the country. But, you know, everything that's happening with capital markets, the transition that's happening very quickly, both in public capital markets, new regs, change of rules, different paradigm, but also a lot of it's triggering change now in the private markets in anticipation of what is eventually going to be expected in private contexts. And so I wonder if you could talk a little bit about, we'll start there with your focus around stakeholders. How do you see some of these changes in the capital markets now panning out?
Well, we know that the SEC is putting in regulations with regard to environmental performance. And the European Union, which is going to affect the stock markets in the UK and in Europe, are putting in regulations that are going to affect the capital markets because people are going to have to account for their supply chains and their environmental performance. And all of this is being framed as ESG, environment, social, and governance. And that's what's really driving it. And it actually was a creation by investors who saw in ESG an opportunity. People can say, well, it's an opportunity for them to make money, but in the positive sense, it's an opportunity for them to affect change because many of the large investment companies like BlackRock or Vanguard or State Street, the big three, recognize that companies that don't change their environmental policies will end up not performing very well in the market, and their cost of capital go through the roof because eventually lenders are going to look at it and say, well, if your portfolio includes things that stakeholders will not tolerate or regulations won't tolerate anymore or restrictions, your cost of capital is going to go crazy and your investment portfolio or your performance is going to go, as well as your market value. The market value of companies that are performing well in terms of environment and social performance are outperforming those that are not. And they're also attracting proxy fights of people who no longer want to tolerate a company that is using their investments to damage things.
Well, you know, that's interesting you bring up the proxy fights too, because what folks don't realize is that as the situation, as the dynamics in the public markets escalate, right, and you've got more and more sophisticated proxy wars, you have a whole, what we call a scrutiny economy, right? You have the scrutiny industry. And these are well-funded, well-heeled nonprofits as well as for-profit consulting firms and advocacy groups and other kinds of operators that are supporting the ability to raise the bar on these proxy wars. And so you've got them happening on both sides of the political spectrum. And you know, it is encouraging that a lot of the ESG related stuff has a higher percentage of being passed or at least getting to a serious level of hearing and a vote than some of the other stuff. But, you know, it's still, there's a lot of pushback going on against even the ESG stuff that makes a lot of sense by opposing forces. So we're not anywhere too far along, are we, in kind of the tug of war that's going on right now?
Well, you know, there is a tug of war, and the greatest pressure CEOs and boards are finding is from company employees. Yeah. You're right in terms of the NGOs and different advocacy groups. But employees, if you look at Disney, for example, Disney walked into a battle with the state of Florida unprepared. It was amazing naivety on their part. They were asked by employees why they had not taken a stand on this legislation that was called Don't Say Gay. And the answer was that they gave was, well, we're playing our role behind the scenes through our lobbyists. And many of the employees said, well, that's not good enough. We want you to speak out on this because this affects us personally, many of them, as well as offended their morals and ethics in terms of what was happening in the state of Florida. By the time the CEO, Bob Chapek, who had pledged that he wasn't going to get involved in social and political dialogue externally, he called the governor, DeSantis, announced that he had a good call. The next day, DeSantis called a press conference and declared that this was a woke California company trying to impose its views on Florida. And so where do you go from that? So what I've been saying about ESG is, first of all, ESG has primarily been seen as environmental. And there are many, many social and political issues. We see what happened with the Russian invasion of Ukraine, of companies reacting very quickly. Some pulled out, some didn't. And Shell pulled out, then didn't pull out, then pulled out again and said they made a mistake. So something is going on with companies. And what I've been saying to companies is, really, you need to put your governance, we call it ESG, it should be GES. Governance is what really determines how you will handle your environmental and social activities. And when you talk about governance, governance is not compliance, it's really good decision-making. And good decision-making comes from an understanding of your values, because those values influence the strategic choices you make. Companies really now have to look at the opportunities and risks that they have, look at them together, not separate, not strategy, and then we come back with risk, but look at the opportunities and risks for each stakeholder group, because it's going to be very difficult to balance every stakeholder. You have these very activist groups that have an agenda. Some of them I may agree with, some of them I may not agree with. You may have different views, but they're asking companies to do things. And companies need to be not listening to the squeakiest wheel and giving that the oil, but understanding what they stand for and making decisions. So we have companies like Patagonia that are completely guided by political values. They were founded on environmental performance. They in their statements, they say we're willing to give up profits to save the environment. They pulled out of Jackson Hole, Wyoming, one of their biggest customer bases, because they disagreed with the political positions that Jackson Hole was taking during the last election. That's their value system. Now, on the other side, you have companies like Chick-fil-A and Hobby Lobby that are guided by a different set of principles. But both of those companies all those companies know what they stand for and they follow them through. And I may not like one thing or the other, but I respect them because of that.
Well,
most companies are not like that. Most companies are in the middle.
Yeah, and the other thing too that people forget is that, when we talk about stakeholder capitalism versus shareholder capitalism, right, which is the new paradigm that we have been operating in for a while, right, because a lot of the overseas markets matured into a structurally supportive multi-stakeholder capitalism model before we did in many ways, if you think about it. because they were able to accommodate a lot of government-oriented programs around sustainability concerns in the EU countries particularly. So, you know, the US is still catching up with some of this stuff. And the other thing too is that people forget that this notion of multi-stakeholder capitalism also comes from the fact that over at a certain point in history, and I'd say probably, you would probably agree, like the last 20 to 25 years, shareholders have been community activists. Shareholders have been owners of property next to an environmentally dubious installation run by the company they're investing in. Shareholders can run for a public office or be on the school board or be reviewing curriculum or whatever within the community where the company has a presence. Shareholders can be members of nonprofit organizations that end up having opposing agendas to where your primary holding in your portfolio is. There's all this mix now of roles besides being singularly a shareholder, and folks forget that this notion of multi-stakeholder capitalism isn't just built on creating the obvious external connections for new interdependencies, but in fact, we're already inherently connected because we're in multiple relationships to an entity, to a business entity.
Well, think about the fact that when you really come down to it, the term organization comes out of the Latin organ, and the term corporation comes out of the Latin corpus, a body. These are living things. They were created as living things. And
right.
As living things, you're part of an ecosystem. And I liken it to a garden. If you're only extracting nutrients, and that's your entire, and you're like a weed, you'll kill the garden and you won't have any more nutrients. You'll die with the garden. That we exchange value with stakeholders. And when we really realize we need stakeholders to provide us back with the value we seek. And so I look at, value, you look at it competitively, and you can see if you're not getting the same value in terms of profits or relationships or whatever information or whatever the value you seek is, something is competitively wrong. You're losing to your stakeholder, your competitors on that given stakeholder. So you really need to ask yourself, how am I doing versus my competitors in attracting the top talent? How am I doing in attracting customers where the first thing they ask is not price, but they ask for other things? And what we're finding is that in this new world of stakeholder relations, the most important expertise you have is relationships.
Well, when you speak of that, it's another thing you're speaking of here is like stakeholder sentiment, right? So do you have a mechanism in place within your organization to be processing stakeholder sentiment in an ongoing basis, right? So do you have some kind of dashboard technology cross teams that's allowing you to mine external data from reliable sources and have it processed in a way that gives you the kind of analytical dashboard or radar screen, if you will? And how is that information being filtered through the rest of the company for product development, for customer service, for warranty effectiveness, all of these different operations internally, up and downstream of the organization that support the external experience? But, to your expertise and background around all of this, what about the board? Isn't it that one of the challenges going forward for private company boards, for family business boards, family councils, is to be able to have unfiltered data that the board can use for their own way of working in looking at data, analyzing data, looking at direct sentiment analysis for all the different stakeholder groups, so that because one of my arguments is the boards need to be doing more future casting, right? They're not doing enough future casting. everything's kind of in the rear view mirror. Everything's kind of risk management right ahead of the next quarter. Everything, I mean, obviously we got caught with our pants down with the supply chain crisis and COVID. Nobody did the kind of contingency analysis and scenario planning that actually put contracts in place for operational contingencies, that so when a certain stress level reached a breaking point, boom, it triggered certain events that were already contractually in place, right?
Well, I mean, your point is well taken. Boards really, and I just was with a board last week and I said, your number one thing is to help the CEO navigate the future. Most of your board meeting should be focused on the future, not the past.
Right.
The past informs the future, but where is the market going? Where are you intersecting the market and where you're not? And we're in such a complex world. When you think about the way organizations, whether they're private family organizations or large organizations, are organized, they're in silos. So we have different departments filtering up information. Most of those departments do not share information. They don't pass it along to others. And my greatest advocacy is right now is to have companies form a cross-functional team that evaluates all these opportunities and risks so that the board doesn't listen or the CEO doesn't listen to the last person who came in the room, but they're getting a comprehensive view on what to do. The world is way too complex for any one discipline or any function to understand what's going on. And so take all the stakeholder facing functions along with risk management and legal and put them together. And you have a very dynamic information flow up to the board.
Well, you also make a good point there too about, not reformatting how the CEO is exposed to all of this intelligence sharing and information so that not one person can play the old traditional power game and be the last one in the room to say the last thing the CEO hears, right? Because we all have worked with enough CEOs that we know that there's a pattern, there's different kinds of leadership patterns that people fall into for a variety of reasons. Some fit their personalities, fit their weaknesses, double down on their strengths and improve their weaknesses. There's different reasons people, envelop a certain leadership style. And to the extent that the kind of transformation required of private company leadership now is, I think, necessitates that the board do more self-care, right? The board look more reflectively at themselves, look at how much they've been able to accomplish, where they have fallen short by being frank and candid with each other, but also having the kind of self-care approach so that they are able to be more, to raise their level of openness to change, to new data, to a broader scope of view, because if you're going to invest in these diversity profiles, you've got to assimilate the data into the DNA of the organization, right? And be able to do this in a way that enables the board to operate differently than the way it has. I mean, so I think it's both, internal self-care as well as, properly responding to the change they can't control.
Yeah, the thing I work on most with boards is how to gain greater efficiencies within the boardroom. Mm-hmm. And how to deal with conflict. And actually, right. Conflict is good as long as it's constructive contention rather than real conflict.
Okay, so Elliot, you talked a lot about the yin and the yang of reputation management. You have a great book out. Tell us a little bit about that.
Yeah, so this is the book. It's on Amazon. It's in Kindle, softback and hardback. It's called The Yin and Yang of Reputation Management: 8 Principles for Strategic Stakeholder Value Creation and Risk Management. And the reason why I call it yin yang is just what I was talking about of opportunities and risks. Everything is connected. And whatever you do, the concept of the Taoist concept of yin yang is that everything's connected, night and day. The water flows in, the water flows out. Well, companies, everything they do gets a reaction. And you need to understand the reactions so that you can manage them and anticipate them. Most companies are extremely reactive and very defensive. And in the book, I try to help people to understand, first of all, reputation is not about the best PR and marketing. It's about meeting expectations of stakeholders better than your competitors. And that's an enterprise-wide activity, connecting everything you do to be the best you can be.
Yeah, it makes a lot of sense. It's a holistic approach, right? Soup to nuts. You know, they call it, they simplify it by saying walking your talk. But in fact, it is about engineering every touch point you have with a stakeholder and making sure that in all of those behaviors, whatever those touch points are, however simple, however sophisticated, there is a consistency of experience for that receiver.
Absolutely.
And building that kind of trust and confidence and dependability and so forth. Yeah, it's great stuff. Elliot Schreiber, thank you so much. We'll be talking more about it. So taking another look at the way the world is quickly changing in this new ESG reality. Art Stewart with you. What matters most here on LinkedIn and YouTube? We'll see you next time.
Thank you, Art.